Welcome to Lesson 3 on Market Foundations for Trading. In this lesson, we will focus on how orders work and the mechanics you'll use when trading. Before placing any trade, you must understand how orders work. Whether you trade Forex, stocks, indices, or crypto, the type of order you choose is critical. By the end of this video, you will know how to use orders the right way to control risk and improve your entries. We will break down market, limit, and stop orders and discuss the difference between buying and selling, going long versus short. We will also cover the hidden costs like spread, slippage, and commissions. Mastering these concepts will allow you to trade with structure, confidence, and intention. A market order is a basic order to immediately buy or sell at the best available price. Its key characteristics are immediate execution and the best available price. However, you face price uncertainty due to slippage, meaning execution is guaranteed, but the exact price is not. Traders use market orders to enter or exit a position quickly, prioritizing speed over price precision, especially in highly liquid markets. The risk is slippage in volatile or illiquid markets, giving you less control over the execution price. A limit order gives you control over the price, instructing your broker to buy or sell at a specific limit price or better. A buy limit order executes only at the set maximum price or lower. A sell limit order executes only at the set minimum price or higher. For example, to buy a $100 stock at $95, you use a buy limit order at $95. Key characteristics of limit orders include price control, better control over costs, and usefulness for strategy, allowing you to set entry or exit points in advance. The trade-off is the lack of execution guarantee. The order might never fill if the market doesn't cooperate. A stop order, often called a stop loss, automatically buys or sells when the price hits a specific trigger level, known as the stop price. For example, a sell stop order is placed below the current price to limit losses on a long position. Once triggered, it becomes an active market order. When the trade price hits the stop order is triggered and converts into a market order. The broker then executes the buy or sell at the best available price. Since it becomes a market order, the actual execution price can differ from the stop price due to volatility. Traders use stop orders mainly for risk management, automation, and strategic entries. The most common use is to limit losses. For example, placing a stop loss at $95 on a stock bought at $100 automatically closes the position if the price falls, preventing larger losses. Stop orders are also used to protect profits. If you buy a stock at $100, it rises to $120, and you move your stop to $115, you lock in a $15 profit if the price falls back. This strategy is called trailing or protecting gain. Stop orders automate trades, executing automatically when a price level is reached, even when you're away. This removes emotional decision-making. They are also used to enter trades on breakouts, such as placing a buy stop at $51 above $50 resistance to catch strong momentum moves. Finally, stop orders are vital for managing risk in a trading plan. Professional systems require every trade to have an entry, stop loss, and target. Stop orders help traders define risk, such as risking $100 per trade, making losses controlled and predictable, which is critical for survival in markets. The most basic actions in financial markets are buying or selling, executed through buy orders and sell orders. An order is an instruction you give to a broker to buy or sell a financial asset, such as a stock or cryptocurrency. A buy order is an instruction to purchase an asset from the market. When executed, you receive the asset and the seller receives the money. Financial markets rely on buyers and sellers constantly matching through exchanges and brokers. Conversely, a sell order is an instruction to sell an asset you own to someone else in the market. When executed, the buyer receives the asset, and you receive the money. Every trade requires two sides, the buyer who wants the asset and the seller who wants the money. A trade only happens when a buy order successfully matches with a sell order. In trading, the buy direction is called long. You buy long because you expect the price to increase. The sell direction is called short, or exit. Selling can mean closing an existing long trade or initiating a new trade called short selling. where you profit if the price falls. The spread is a critical concept. It is the difference between the price buyers are willing to pay for an asset and the price sellers are willing to accept. This gap is calculated as the ask price minus the bid price. To understand the spread, we define the bid and ask prices. The bid price is the highest price buyers are willing to pay. The ask price or offer is the lowest price sellers are willing to sell for. The difference between these two prices is the spread. The spread exists because buyers want to pay less and sellers want to receive more. This gap reflects those conflicting expectations. It also compensates brokers, dealers, and market makers for providing market liquidity. Slippage is the difference between the price you expected to get when placing a trade and the actual price at execution. It means your trade was filled at a different price than requested. Slippage occurs in fast markets due to high volatility and news events when prices move quickly. It also occurs with low liquidity, where there are not enough buyers or sellers at your requested price. Market orders are generally more susceptible to slippage than limit orders. It's important to note that slippage isn't always negative. Negative slippage means you get a worse price than expected, but positive slippage means you get a better price than expected. Commissions are fees charged by a broker for executing your buy or sell orders. It is a cost you pay to your broker for their service in facilitating market access and executing your trades. Commissions can be charged per trade, per lot, or per share, often applied to both entry and exit. It is separate from spread and slippage. Be aware that some brokers offering, quote, no commission might instead include costs in a wider spread. Mastering order types, understanding market direction, and controlling these hidden costs are the foundations of effective trading. By operating with clarity, structure, and intention, you can gain a significant edge in the market.